Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and as you can see in front of your screen today we are going to practice a section C question called as Gadner company. The same question is available on your ACCA practice platform wherein it is the very first question of your section C. So having a quick look at the requirement, I can clearly see that this question wants me to first find out the market value weighted average cost of capital of Gadner company, and this requirement is worth 11 marks. So this is the scenario which pertains to the requirements. Let us have a read at the scenario now. So the scenario says Gadner company wishes to calculate its weighted average cost of capital. The company has the following sources of finance: ordinary shares 10%, preference shares 8%, loan notes, bank loan. Ordinary shares information is given to us. They have a nominal value of 0.2 per share and currently trading at 6.35. Equity beta is given. Then you can see information with respect to preference shares. Then you have information pertaining to loan notes, and then you have the bank loan fixed interest rate of 7% per year. They have given you the yield on short dated UK treasury bills to be 4%. This can be taken as the risk-free rate because government treasury bills are considered to be risk-free. So we will consider 4% as our risk-free rate, and we have been given with the equity risk premium. This is itself given that we do not need to subtract from this the risk-free rate. This is already the risk premium, already the subtracted figure given to us. And then we have the corporation tax rate of 20%. Now let us get on to solving the very first requirement, which requires us to find out the market value weighted average cost of capital of Gadner company. Now we are going to first get started with the costs and then we will find out the market value. So let's first find out the cost of equity. So with respect to the cost of equity, we are simply going to use the CAPM model. So with this, KE can be found out equals to, you're going to take the risk-free rate is 4%. You need to add to this the beta which is given to us again 1.25 multiplied by whatever is the premium, which is 5.6%. So this is the CAPM formula, and now if you hit enter you will have the KE as 11%. You can convert it to the percentage format, and this is what your cost of equity is going to look like. Now let's talk about the cost of capital of the irredeemable preference shares. This is the information pertaining to preference shares. So we will now talk about cost of preference shares, and this is in short written as KP. So KP over here, whenever these are irredeemable ones, the formula that we are supposed to use is we take the preference share dividend and then we are supposed to divide it by the value that they are at. So the cost of preference shares, let's find out. This is the nominal value of 0.5 and the market value is also given to us as 0.55. So now the cost of preference shares, as you can see, these are 10% preference shares. 10% dividend is given on their nominal value, which is 0.5. So first we will find out the dividend. Dividend that they give is equals to 10% of 0.5. So this is our dividend, and now we can find out the KP. KP is going to be our dividend divided by the market value, which is 0.55. Now this can be converted to a percentage to find out your final answer, which is going to be 9.09, or you can say 9.1% rounded to one decimal place. Now let's talk about the next thing which is given to us. This is with respect to the 8% loan notes. These are 8% loan notes. They have a nominal value of $100 per loan note. This is the market value, and they are redeemable in 6 years time at a 5% premium to the nominal value. So how are we going to find out? We will lay down all of the cash flows which are associated, and then we will be finding out the market value. So basically we use the IRR method over here. Let's plot in the cash flows. If you talk about year 0, you have minus whatever is the market value, is 108.29. This is the present value. Now 1, 2, because they are redeemable in 6 years time, we have data till 6 years. So this is the information till 6 years. Now firstly, in the very first year, all of the interest payments are going to be made. So the interest with respect to the loan notes, basically 8% is the rate of discount. So they are going to get 8%, but then you're also going to make it after tax. So 8% of 100 is $8. This needs to be multiplied by 1 minus the tax rate, which is 20%. So this is our rate of interest. Now 6.4 is what the investors are going to get for all of the years, and in the last year there's going to be one change. The change is we are redeeming our loan notes, and the redemption is going to be 5% premium to the nominal value. So 100 and 5% premium will be 105. So this is the amount of money that any investor is going to receive in the very last year. Now what we are going to do is we are going to simply use the IRR formula equals to IRR, and we are going to select all of the cash flows. And with this, you will get in your after tax KD. So you convert it to the percentage format, and this is your after tax KD. So you will say cost of debt, and you will write KD over here. So now this is your KD all calculated. Now let's talk about the bank loan. So bank loan, the cost is already given to us, which is 7%, but this is before tax. So we need to convert it to the after tax cost. So basically I'll write bank loan and I'll write after tax KD. After tax KD is going to look something like whatever is your rate as of now, and then that needs to be multiplied with 1 minus the tax rate. So 1 minus 20%, which is the tax rate. So you hit enter and you will find out that this is going to be the cost of capital which the business will effectively pay because of having this bank loan. So this is now all of our costs calculated, and then we will be looking at the market values now and then find out the weighted average cost of capital. So now that we have all of our values, we are going to find out the market values. So this is with respect to market values. So first of all, let's do it for equity, normal equity that we have. So the normal equity is supposed to be, let's have a look, 6.35 is the value of one share, and how many number of shares do we have? So for number of shares, we have a very simple formula. Whatever is your total value according to the books, which is 8,000, and then that needs to be divided by your nominal value of one share. So then it is going to be 0.2, which is the nominal value given to us right over here. Now if you hit enter, you will find out the number of shares, and now the number of shares needs to be multiplied by your per share market value, and then you will find out the market value of your equity. So per share, you can see your share is priced at 6.35. So now the market value of your equity is going to look like this. So now this is your market value of equity. Now the next source which we are going to talk about will be the preference shares. So preference shares, firstly we will again find out the number of shares. So the number of shares is 2000, and then that needs to be divided by the nominal value of 0.5. So these are your number of shares, 4000, and now you have to find out per share. Per share is given to us. Per share is 0.55. This is the market value, and then preference shares can be valued at this multiplied by this number of shares multiplied by how much one share is trading at in the market. So this is our equity and preference shares valued. Now we are going to find out the market value of your loan notes. So with respect to the loan notes, let's have a look. 6,000 is the value according to our books, and nominal value is going to be 100. So number of notes you can find out as 6,000 divided by 100. So this is your number of loan notes, and now you are supposed to take it multiplied by the per loan note market value. Per loan note, you can see 108.29 is the trading value at the moment. So now the value of your loan notes comes out to 60 multiplied by 108.29. So this is the value of your market value of your loan notes. Now have a quick look at the bank loan. Bank loan is not traded in the market, so the book value itself is the market value. So you're going to take 2000 over here. I have done all my workings in these thousands, so 3 zeros we have completely ignored. So this is the value of your debt. Now if you want to find out the total of all of the sources of your finance, first you will add the bank loan, then you can add the loan notes, then you will head to the preference shares, and then you will finally add the equity. This will give you the total of the market value of your different sources of finance. Now you can simply calculate the WACC. WACC can be calculated using, firstly you're going to put in the formula starting with double brackets because we have a lot of figures to cater to. Firstly, 11% is the cost of your equity. This needs to be multiplied by the value of your equity. So this is my equity value. Then you need to add to this the percentage of cost of capital of the preference shares multiplied by the value of the preference shares. Then you need to add to it the loan note percentage KD, which is 5.47%. This needs to be multiplied by the market value of your loan notes, and then you need to lastly add with respect to the bank loan. Bank loan after tax is this, and then it needs to be multiplied by the value of the bank loan. So this is your numerator. This needs to be divided by the total final value of your all sources of finance. So if you hit enter, you will find out your weighted average cost of capital. Convert it to percentage. I think this also was remaining. So converting this also to percentage format. Now you get 10.81 as your final answer of the market value weighted average cost of capital. Now let's head to the next part, wherein this part requires you for 4 marks to explain the meaning of the terms business risk and financial risk. This is a pretty straightforward question. No linking from the scenario is also required. Very general, 2 marks, you can explain each of them. I assume that while you were doing your studies, you would have studied this concept. Now, I'll just give you a brief overview. Business risk is going to relate to any risk which pertains because of our nature of industry, the business that we do. So, it is going to be some variability of your returns because of business operations. How you can measure it, you can find out from the SOPL perspective by looking at the operational gearing, where you are seeing how much fixed costs and variable costs do you have in relation to your PBIT. Now, if you talk about operational gearing, it can be calculated as contribution divided by PBIT, and business risk is not going to be influenced, or you can say affected, by how the company is financed. So if the company has too much debt, no debt, it is not going to impact the business risk. Business risk solely relates to the business that you do. Now talking about financial risk essentially is about any risk which is there because of the capital structure of the company. So you can find it out using the balance sheet perspective by having a look at the gearing. Gearing means debt to equity ratio. So from the SOPL, you can have a look at interest cover and income gearing. So if you combine both of these risks, business risk and financial risk, then you know the total risk of the company. Now let's talk about the part C. Part C, again, as you can see, no linking to the scenario is required. You have to discuss the key features of a rights issue as a way of raising equity finance. So whenever you do a rights issue, basically what you're doing is you can talk about maybe 4 or 5 subheadings over here. One thing that you can talk about is the preemptive right of shareholders. This means whenever you want to preserve the balance of ownership and control, your existing shareholders, what happens in a rights issue, right? So you basically offer the existing shareholders to buy shares in the company before you are offering the same to other people. So this is known as preemptive right. What it essentially does is you are not going to disturb the ownership and control. Earlier, how much ever percentage of control the shareholder was having, now also if they take up the right issue, they will have the same percentage of ownership and control. The next feature that you can talk about is the rights issue price and the cumulative rights price. The price at which you issue the shares is called basically the rights issue price, and the share price that is there after the rights is announced is known as cum rights price, and the rights issue price is at a discounted price to this price. Now let's talk about TERP. So TERP is basically the share price after the rights issue has taken place. So this is going to be the weighted average of the cumulative rights price and the rights issue price. So this is basically the formula that we apply to find out TERP. Then the next factor or the next feature is neutral effect on shareholder wealth. So as you would have also probably observed in numerical questions, the one that's there on Study Hub also, you will find out that if a shareholder takes up the right or if they sell their right, renounce and sell their right, then they have the same effect. The gain or loss is the same. But if they do nothing, then they in effect end up losing. So it has a neutral effect. That means it does not matter whether the shareholder keeps their rights shares with them or they renounce and sell it in the market. Then the next feature which you can talk about is the balance of ownership and control. You are providing the existing shareholders to buy the rights which they are entitled. However, this is something which is optional. So you are in a way giving them the opportunity to preserve their ownership and control. If they want to, they will take it up. If they don't want to, then it's their own choice. And then next you have underwriting. So whenever you have to ensure that the company will receive the fund that they need, rights issues are underwritten as a form of insurance. So that means whichever shares are not taken up by your existing shareholders, they will be taken up by the underwriters, and for the same the underwriters are going to charge underwriting fees. So this is the explanation of Gadner company. I hope that this was useful. Do let me know if you have any queries or if you would like me to solve any more questions. Thank you for watching.